This chart shows the culmination of the July 24th session. On the far right, a single red candlestick drops from 65.5K straight through 64K in a matter of minutes. The trajectory of this drop aligns with the coordinates of a dense structural layer formed days prior. This aggressive downward movement was a mechanical liquidity sweep. In modern high-frequency environments, derivatives positioning dictates these highly localized and violent price vectors. Recognizing this price action as a structural inevitability changes how quantitative traders interpret short-term market volatility. We can investigate this structural anomaly using the liquidation leverage heat map. The purple regions on the chart represent empty space. These are neutral zones where leverage is absent and there are no significant order blocks to attract price. The bright yellow horizontal bands indicate highly concentrated, over-leveraged order blocks acting as structural anomalies. To understand the crash, we have to wind the clock back 96 hours and deconstruct the order flow that built this trap. Mapping liquidation leverage allows traders to view the market as a deterministic map of where price is forced to move to facilitate order flow. On July 20th, the price behavior originating at local lows suggests a deliberate shift. From 63.8K, Bitcoin begins a sharp upward reversal. This reversal targets the dense yellow band of short liquidations parked at the 66K level. This is a textbook example of algorithmic liquidity seeking in order matching. When a short position is liquidated, the exchange generates an involuntary market buy order. Large entities use these zones to match those forced buys against their own limit sell orders. This provides the high-volume exit liquidity required for institutional players to offload positions without causing slippage. By the evening of July 20th, the price has tapped the zone, and the targeted yellow band has vanished. The fuel for the move is gone. These sharp upward vectors are mechanical operations designed to clear short liquidity and create a temporary vacuum above. On July 21st, price action settles into a lateral range, chopping sideways between 66K and 67K. The critical data is the structural shift occurring beneath this price action. Heavy new yellow bands are rapidly accumulating at the 65K and 65.5K levels. As retail traders and automated systems identify these recent local lows as a support zone, a new imbalance forms. Market participants are stacking highly leveraged long positions precisely at this threshold. By July 22nd, the price is hovering heavily just above a massive 65.5K liquidation band. The density of the liquidity trapped below the current price now vastly outweighs the available leverage above it. By the end of the day, the accumulation of long leverage has pushed the path of least resistance strictly to the downside. On July 23rd, the market makes repeated attempts to break out. Momentum pushes upward, but hits a ceiling, spreading laterally as the move exhausts itself. Upside momentum is mathematically capped because the short liquidity pools above were already cleared in previous sessions. As the price fails to maintain altitude, it reverses and breaks down below 65K. This creates a gravitational pull toward the nearest dense pocket of leverage. With upward liquidity drained, the market naturally drifts towards its counterparties. Price stabilizes temporarily, exactly inside the newly formed 64.5K density zone. Lateral price action like this often signals a market sitting on the precipice of a high-density liquidity pool. This brings us back to the aggressive downward slice on July 24th. The mechanical trigger was price tapping the outer boundary of that 65.5K leverage band. Tapping that zone triggered a chain reaction. The first long liquidations forced involuntary market sells, hammering the bid and pushing price lower. This drop instantly triggered the next band of leverage, compounding the selling pressure exponentially. This aggressive mechanism creates a self-fulfilling downward flush that can entirely obliterate days of leverage accumulation in mere minutes. Traditional analysis relies on arbitrary support lines, but the cold reality of order flow is different. In derivatives-heavy asset classes, historical support is secondary to real-time liquidity density. The 4-day sweep and flush cycle observed here is a standard recurring engine of market movement. Mapping liquidation leverage strips away sentiment and transforms reactive charting into predictive structural analysis. Ultimately, the market is a liquidity-seeking mechanism. Accurately identifying where the leverage lies provides the definitive map of future price vectors.